Every market bubble begins with a story, not a chart, not a valuation model. A story. A story that sounds reasonable at first, then persuasive, then obvious, and finally, unquestionable. This is where most people get it wrong. They believe bubbles are caused by bad assets, overhyped stocks, useless technologies, speculative instruments. But history shows us something far more uncomfortable. Bubbles are not driven by assets. They are driven by human psychology. The same psychology, over and over again. Across centuries. Technology changes. The names change. The charts change. But the emotions don't. Tulips, railroads, radio stocks, .com companies, housing, crypto cycles, different eras, same brain. At the core of every bubble is a powerful mental shortcut. This time is different. Not said arrogantly, said confidently, but it's different because technology is changed. Monetary policy is different. Central banks won't allow collapse. This asset is the future. Old valuation rules no longer apply, and here's the key insight. The people saying this are not stupid. They're often intelligent, informed, and well-intentioned. That's what makes bubbles dangerous. Because intelligence doesn't protect you from bias. Sometimes it makes bias harder to detect. One of the strongest forces in bubbles is social proof. When everyone around you is making money, caution feels irrational. When friends outperform you, skepticism feels expensive. When media celebrates gains daily, restraint feels like ignorance. Your brain interprets collective excitement as information. This many people can't be wrong. But history is brutal on this belief. Tulipmania in the 1600s wasn't fueled by peasants. It was driven by merchants, professionals, and the wealthy elite. The dot-com bubble wasn't built by amateurs alone. It was fueled by analysts, fund managers, and institutions. They didn't lack data. They lacked emotional distance. This is the first sign of a bubble. Narratives replace probabilities. People stop asking, what are the risks? And start asking, how do I get exposure? Fear of missing out becomes stronger than fear of loss. And FOMO is not greed. It's anxiety. Anxiety about being left behind. About missing the moment. About looking foolish later. Ironically, bubbles are often born in environments that feel safe, stable growth, supportive policy, easy money, high confidence. When volatility is low for a long time, people forget risk exists. And when risk is forgotten, leverage enters quietly. More borrowing, more margin, more speculative positioning. This is when bubbles accelerate. Not because assets become better, but because people become more confident. And confidence, once it detaches from fundamentals, becomes momentum at this stage. Skepticism is punished. Anyone who warns about risk is labeled out of touch to conservative. Didn't get it that social pressure matters. Because humans are wired to avoid isolation, so they compromise. They invest just a little. They hold just in case. They rationalize exposure. And that's how bubbles expand. Not explosively at first, gradually, quietly, until the belief becomes universal. That's when danger peaks. Let's ground this in history, because history is ruthless. With repetition, tulipmania is often mocked, but it's deeply misunderstood. People didn't believe tulips were magic. They believed demand would always exceed supply. Prices reflected rarity. Others would always pay more. Sound familiar? Contracts changed hands multiple times before delivery. Speculation replaced ownership, and price became disconnected from use. That's a psychological shift. When people stop asking, what is this worth to me? And start asking, what will someone else pay? You've entered bubble territory. Fast forward to the dot-com era. The story wasn't these companies are profitable. It was, they'll be profitable later. They're gaining users. They're changing the world. And many of them were. But belief outran reality. Valuations became symbolic, not analytical. The metric wasn't cash flow. It was imagination. And imagination is infinite. This is another bubble signature. The future is pulled forward and priced as if it already happened. Any challenge to that assumption feels hostile. Now here's the part people avoid. Bubbles don't pop because people suddenly become rational. They pop because liquidity changes. Confidence holds until it's tested. A rate hike, a funding freeze, a regulatory shift, a failure somewhere unexpected. The trigger doesn't matter. What matters is that belief meets friction. And when belief breaks, it breaks fast. Because leverage works both ways. What took years to inflate can unwind in weeks. Here's the key lesson from history. Bubbles are not identified by price alone. They're identified by behavior. Specifically, Dismissal of risk, moral certainty about outcomes, social pressure to participate, complexity replacing clarity, confidence, in continuous liquidity. If you see those behaviors, the asset doesn't matter. It could be tech, real estate, AI, crypto, anything. Now, ask the uncomfortable question. Do we see those behaviors today? You don't need to answer yes or no. Just observe. Listen to how people talk about markets. Are cautionary voices respected or mocked? Are valuations debated or waved away? Is risk discussed or reframed as opportunity? Are people investing or speculating? There's a difference. Investing focuses on durability. Speculation focuses on timing. When speculation dominates, bubbles thrive. And here's a subtle but critical point. You don't need to predict the top to protect yourself. You need to recognize conditions. History doesn't repeat exactly, but psychology rhymes perfectly. So where does that leave us right now? This is where responsible analysis matters. Not everything expansive is a bubble. Not every rally is irrational. Not every new technology is hype, but not everything rising is healthy either. The most dangerous mindset is binary thinking. Everything is fine or everything is doomed. Reality lives in between. The better question is, where is psychology outrunning fundamentals? In 2026, markets are shaped by forces that didn't exist in earlier bubbles. Central bank intervention, passive investing flows, algorithmic trading, global liquidity coordination. These factors can delay corrections, but they don't eliminate human behavior, they amplify it. When confidence is high, money flows faster than ever. When confidence breaks, it exits even faster. That's the modern risk. Speed. Another key factor is narrative saturation. Today, market narratives spread instantly. Social media accelerates belief. Echo chambers reinforce conviction. Dissent gets filtered out. This compresses the bubble life cycle. Faster enthusiasm, faster denial, faster unwinding. So what should a thoughtful investor do? Not panic, not chase, not predict dates, but observe behavior. Ask, is leverage increasing quietly? Are people using certainty language? Is risk being dismissed or reframed? Is liquidity assumed rather than questioned? These are psychological indicators, and they matter more than price targets. History shows that people who survive bubbles don't do so by being early bears. They do so by avoiding excess leverage, maintaining liquidity, diversifying thoughtfully, accepting that missing upside is cheaper than suffering forced exits. This is not about being right, it's about staying solvent. The biggest tragedy of bubbles isn't losses. It's that they trap people at exactly the wrong time, when flexibility matters most. And that's why understanding psychology is more valuable than predicting charts, because charts change. Human behavior don't. So, here's the final question to leave with your audience. If history were repeating not exactly, but psychologically, what would it look like? And more importantly, how would you want to be positioned not to win big, but to survive comfortably? That's the mindset that separates observers from participants. And in every bubble, survival quietly outperforms brilliance.